Welcome to our LBO valuation model tutorial. My name is Tom Folliard. I'm the owner and developer of the CorpFin.net software. Before we begin the tutorial, let me make 3 quick points about our software. First, if you're looking for a spreadsheet-based product to create a valuation or to build models from scratch, you've come to the wrong place. All of our applications are web-based, our code is proprietary, and it's not downloadable into other software applications. Second, all of the CorpFin.net software applications are developed for use in our financial advisory business. The applications have been vetted and used for over 6 years by our partners, who are all experienced corporate finance practitioners and CPAs with Big Four backgrounds. Third, a 5-year financial forecast is a key component of the LBO valuation process. It would be a good idea to become familiar with our forecast models before proceeding with this LBO valuation tutorial. There are links on our home page to our forecast model tutorials, demos, and descriptions. As we begin this tutorial, we will first describe what an LBO transaction is, what an LBO valuation is, and we'll review a few of the key attributes of our LBO valuation model. Following that, we'll create an LBO valuation using our model, explain the key assumptions, and review the valuation reports. A leveraged buyout, or LBO, is a type of business acquisition in which a buyer acquires a company and uses debt to finance a significant percentage of the purchase price. The percentage of debt in a specific transaction depends largely on the financial and operating characteristics of the company to be acquired, the state of credit markets, the market value of the assets to be acquired, and the buyer's appetite for financial risk. The debt is usually in the form of secured bank loans and, if the acquisition is of sufficient size, subordinated debt provided by investment partnerships. In an LBO transaction, the assets of the acquired company are pledged as collateral for the debt, and the acquired company is the borrower. The debt is non-recourse to the business buyer, meaning the buyer is not liable if the debt is not repaid by the borrower. If the borrower defaults on the debt, the lender may seize the pledged collateral, and his debt recovery is limited to the amount he could realize from the disposal of the collateral. The proportions of debt and equity capital used to finance LBO transactions varies according to the historical financial performance and management expertise of both the buyer and the company to be acquired, credit market and general economic conditions, and the perceived ability of the acquired company to meet interest and principal repayment requirements. The LBO form of business acquisition is attractive to a business buyer because he needs to provide only a fraction of the funding for an acquisition. This funding strategy reduces the buyer's at-risk investment and enhances his return on equity investment if the acquired company performs as expected. If the company does not perform as expected, the debt service requirements of the leverage capital structure can range from very challenging to a situation in which the buyer's equity investment is worthless. LBO valuations use the financial structure and analysis techniques employed by LBO buyers to estimate the value of a business. More specifically, an LBO valuation presumes the buyer is a financial buyer, for example an investment fund, that owns no other company in the acquired company's industry and therefore expects all of its investment return to result solely from the forecasted performance of the acquired company. In general, an LBO valuation estimates the minimum current value of a business, since buyers who already own similar businesses and would benefit from operational synergies with the acquired company will usually pay more for a given business than will a financial buyer. These synergistic buyers are also known as industry buyers. An LBO valuation is typically built on a 5-year financial forecast of the acquired company's operations. The valuation analysis forecasts the debt and other liabilities repaid during the forecast period and contains an assumption about the multiple of earnings a business will be sold for at the end of the ownership period. By targeting annual rates of return on equity and subordinated debt consistent with those sought by private investment funds, an LBO valuation provides an estimate of the purchase price a financial buyer would be willing to pay for a business to achieve those returns. Software like ours that produces meaningful and well-documented LBO valuations integrates some fairly complicated math and accounting routines. If your objective is to easily and inexpensively generate and use sophisticated LBO valuations, rather than spend your time creating and debugging your own financial model, our valuation application might be a good fit for you. Like other LBO valuation models, our software presumes the buyer of a company is a financial buyer. Our model uses a 5-year forecast along with other assumptions, including a buyer's required pre-tax return on his equity investment, to estimate the amount a buyer would be willing to pay for a company. Our LBO valuation model is one of 3 robust applications nested within our 5-year financial forecast models for established, startup, and early-stage businesses. This design feature means that once you have completed a 5-year forecast for a company using our software, you are just a few moments and assumptions away from creating 2 LBO valuation cases, each supported by 8 comprehensive reports. Our software enables a user to very easily create an LBO valuation from the perspective of both a buyer and a seller. We call these perspectives cases. Case 1, the most usual analysis, views the business acquisition from the point of view of the business buyer and solves for the purchase price of the business acquisition given the buyer's required return on its equity investment. Case 2 views the business acquisition from the point of view of the seller and computes the buyer's return on its equity investment given the seller's targeted selling price of the business. In instances where parties disagree about valuation, we find that looking at transactions from both points of view leads to constructive discussions and negotiations. From a timing standpoint, our LBO valuation model assumes that the financial buyer intends to purchase the business at the beginning of year 2 of the 5-year forecast, to own the business for the ensuing 4 years, and to sell the business at the end of the 4th year. In order to generalize the LBO analysis across a potentially infinite range of deal attributes, our model assumes the financial buyer buys all of the assets of the business and assumes none of its liabilities. Therefore, the seller of the business needs to pay off all the liabilities of the business and the taxes owed if a gain is realized on the sale of the assets from the selling price paid by the financial buyer. If the buyer assumes any of the liabilities of the seller, the usual adjustment is to reduce the cash amount paid to the seller, dollar for dollar, by the amount of the liabilities assumed by the buyer. The reports generated by our LBO model cover not only the business valuation and the details of the estimated purchase and sale transaction, but also the financial performance of the business before and after the sale. This feature makes our LBO model useful to both prospective buyers and sellers because it acts as a proof of the valuation estimate, and it provides a means to examine the real-world viability of the acquisition transaction. For example, the Case 2 analysis lays out in detail the undesirable financial consequences resulting from a too high business purchase price, not only in terms of an unacceptable pre-tax return on investment for the buyer, but also the debt service challenges likely to occur during the buyer's ownership period due to the mispricing. Before we go through a detailed review of our LBO model, its assumptions and reports, we're going to create an LBO valuation on the fly to show you the model's sequence of events and how easily and quickly one can produce a sophisticated analysis. We're going to create an LBO valuation for Company A. After we've shown you the steps, we'll go through it again in a lot more detail. The steps for creating the LBO valuation are these. From the home page, we access our member menu page and click on Create LBO Valuation, which appears underneath Company A's Multi-Year Scenario 1 forecast. We are transferred to the LBO Criteria page. On the LBO Criteria page, we enter the auction value of Company A's property and equipment and the net amount of expense add-backs expected to occur as a result of the sale of the company. We'll enter the net book value of fixed assets as our estimate of the auction value and 0 for each year for the expense add-backs. We'll then click on Submit to transfer to the LBO Valuation Case 1 page. On the LBO Valuation Case 1 page, we replace the model's 5 placeholder assumptions. We enter 0 for seller financing, 25% for the required rate of return on equity, 6 for the EBITDA terminal value multiple, 8% for the interest rate on senior debt, and 10% for the coupon rate on subordinated debt. We then click Save to create an LBO valuation for Company A, which is based largely on its 5-year forecast and the assumptions we just entered. The valuation we just created is supported with 8 comprehensive reports, which show the details of the purchase and sale transaction, the pre- and post-acquisition performance of the business, and the financial outcomes of the seller and buyer. Not considering our talking, creating this draft valuation took less than 1 minute. Let's go through the LBO valuation creation steps again in more detail, including the assumptions used to create a valuation. We'll conclude by highlighting the 8 reports produced by the valuation model. We'll start by going through the steps necessary to create the valuation. Prior to this session, we accessed corpfin.net, entered our login and password, accessed the secure member section of the site, established a project for Company A, and created a 5-year forecast, multi-year scenario number 1. Underneath that multi-year scenario number 1 is an option to create LBO valuation model. When we click on that option, we are transferred to the Establish LBO Criteria page. The LBO Criteria page prompts us to enter our first draft assumptions regarding the auction value of plant, property, and equipment, and operating expense add-backs or additions, if any, resulting from the acquisition transaction. Once entered, this set of assumptions is treated as a constant for both Case 1 and 2 valuations. Auction value is a fixed asset valuation standard usually used by asset-based secured lenders. Auction value is described as the gross dollar amount that could be realized from a properly advertised public auction on a specified date, with the seller being compelled to sell on an as-is, where-is basis. The auction value, times a percentage called the advance rate, determines the amount a lender will loan on fixed asset collateral. We'll enter $4 million for the auction value. The net amounts of yearly operating expense add-backs and additions are used to adjust forecasted operating earnings so that those future earnings more nearly reflect the expected performance of a company post-acquisition. These adjustments reflect the difference between certain expense amounts provided for in the forecasted operating earnings versus the expected actual amounts of those same expenses post-acquisition. Examples of expense categories which might give rise to operating expense adjustments include various aspects of executive compensation, depreciation expense, operating leases, and building rental expenses. We'll enter $200,000 per year as the expense add-backs. When we click Submit on the LBO Valuation Criteria page, we create model pages for both LBO valuation cases 1 and 2, and we are transferred to the LBO Scenario 1 Case 1 menu page. There we will replace the LBO model's initial placeholder assumptions with ones that are more relevant to our analysis. As part of the LBO model creation, our software saves an unalterable copy of the multi-year scenario to which the LBO valuation relates and establishes model pages for LBO valuation cases 1 and 2. The unalterable copy of the multi-year scenario is automatically tagged with a unique alphanumeric suffix identifier. That identifier is repeated in the LBO valuation case file names and all related LBO reports. This identification scheme provides a complete working paper trail from the specific multi-year forecast scenario through the reports relating to the valuation. Let's now look at the LBO model menu for Case 1. The menu is divided into 2 main sections, namely the Review Change Valuation Criteria section and the Review Estimated LBO Case Valuation section. The Review Change Valuation Criteria section is the key to revising the first and subsequent drafts of a valuation into one that more nearly fits the user's circumstances. Along with the 5-year forecast and the previously entered LBO valuation criteria, the 5 assumptions in this section determine the output of the first draft of the LBO valuation. These assumptions are the amount of financing provided by the seller, the annual pre-tax rate of return on equity required by the buyer, the EBITDA multiple to be used to value the business after the buyer's 4 years of ownership, and the interest rates to be paid on senior and subordinated debt. Again, the only difference between Case 1 and Case 2 assumption sets is that on the Case 1 page, the user enters his annual rate of return objective on his equity investment, while on the Case 2 page, the user enters the seller's selling price objective. Each case's menu page contains a drop-down box with a link to 10 assumptions called advanced assumptions that allow a user to revise certain of the model's default assumptions. These advanced assumptions include the rate of return required on subordinated debt, the percent of purchase price provided by equity capital, transaction fees as a percent of purchase price, and bank loan advance rates, income tax rates, and term loan current maturities by year. Let's now go back to the Case 1 valuation page and review each of the assumptions. Seller financing usually takes the form of an unsecured junior-to-the-bank note representing a portion of the buyer's purchase price. These seller loans usually carry an interest rate near the senior debt rate, which is our model's default assumption. For a given purchase price, seller financing reduces dollar for dollar the amount of purchase price supplied by equity and subordinated debt, which requires substantially higher rates of return than does seller financing. As such, for a given purchase price, any amount of seller financing increases the estimated rates of return for equity and subordinated debt investors. Let's revise the seller financing assumption to $3 million. The annual pre-tax rate of return on equity required by a financial buyer is influenced by a number of factors, including the level of competition among buyers for business acquisitions, the perceived risks associated with the seller's industry and the likelihood of achieving the forecasted financial results, the equity rate of return target for the buyer's investment fund, and the availability and cost of senior and subordinated debt. Generally, the higher the pre-tax rate of return required by a buyer, the lower the business valuation. As we indicate on the LBO Case 1 page, rate of return objectives between 20 and 40% are customary. Let's revise our rate of return objective to 22%. The EBITDA multiple used to value a business after the buyer's 4 years of ownership is a key LBO valuation assumption. EBITDA, an acronym for Earnings Before Interest, Taxes, Depreciation, and Amortization, is a very important business performance metric. When a multiple is applied to EBITDA, the result is an estimate of the enterprise value of a business, which is the ongoing gross value of the business, independent of all its debts and other liabilities. As mentioned previously, our LBO valuation model assumes that a financial buyer purchases a business free of all its debts and other liabilities at the beginning of year 2 of the 5-year forecast, owns the business for the ensuing 4 years, and sells the business at the end of year 4. In order to arrive at the value of the business at the time of purchase, the buyer needs to estimate what he can sell the business for after 4 years of ownership. That selling price 4 years hence is known as the terminal value of the business. The buyer estimates that terminal value by multiplying the EBITDA forecasted for the 4th year of ownership by a factor called the EBITDA multiple. At the end of year 4, a financial buyer assumes he sells the business for the terminal value and he pays off all the debt and other liabilities of the business using the estimated sales proceeds. The sales proceeds remaining after the debt and other liability payments represents the return on the buyer's original equity investment, which he present values to calculate his pre-tax rate of return on equity. Like the rate of return targets on equity investments, EBITDA multiples vary over time due to changes in various economic, credit, and competitive conditions affecting the business acquisitions marketplace. Investment banking firms track EBITDA multiples over time. This schedule shows an analysis of U.S. middle market EBITDA valuation multiples by size of transaction from 1998 through 2009. We tend to be conservative in estimating the terminal value of businesses. We typically use EBITDA multiples lying between the low and average multiples shown on the chart to compute estimated terminal values. As we indicate on the LBO Case 1 and 2 menu pages, EBITDA valuation multiples between 5.0 and 8.0 are customary. Let's revise our EBITDA valuation multiple assumption to 6.0. The final two assumptions on the LBO model menu are the interest rates to be paid on senior and subordinated debt. The reasonable loan rate assumption for senior debt is the rate charged for secured asset-based loans, which is usually the prime rate plus several hundred basis points. Let's revise the senior debt interest rate assumption to 7.5%. A reasonable assumption for the current coupon rate on subordinated debt, as indicated on the menu page, is between 8 and 12%. Providers of subordinated debt typically want to earn a total rate of return on their investment of approximately 20%, with that return coming from a combination of quarterly interest payments and a share of the sales proceeds when the acquired business is sold. As such, the higher the coupon rate on subordinated debt, the smaller the share of the sales proceeds paid to subordinated debt holders when the acquired business is sold. Let's revise the subordinated debt interest rate assumption to 10%. That completes our revision of the LBO valuation assumptions. Let's save our revised assumption set by clicking on the Save button adjacent to Step 2. Once the revised assumption set is saved, the valuation and all the reports related to it are recreated to reflect the changes. If changes are made to the valuation assumptions but not saved, the current valuation is not updated with the changes. The Review Estimated LBO Case Valuation section of the menu lists the output of the LBO valuation model. The reports for both Cases 1 and 2 in both HTML and PDF formats are as follows. The Estimated LBO Valuation Overview Report is a multi-page narrative report that organizes and provides an interpretation of the valuation results. The report is divided into three sections, the first of which, the executive summary, summarizes the valuation results. The second section, the introduction, provides general comments about the sensitivity of LBO valuations to financial forecasts and valuation criteria. The third section addresses the specific valuation case and describes the key drivers of the valuation and the financial metrics achieved during the financial buyer's 4 years of ownership. The report is organized in a manner to help the user logically present and describe the key elements and results of the valuation to a third party. The Estimated LBO Valuation Summary Report is a comprehensive statistical report that depicts the valuation results and the outcomes achieved by the seller and buyer of the business. The report is divided into 4 sections, the first of which, the executive summary, summarizes the principal assumptions underlying the valuation case and valuation results. The second section, the deal, lists the financial details of the theoretical sale of the business, including the gross and total selling price, the EBITDA multiple paid, and the goodwill recognized and its annual amortization amount. Section 3 shows the seller's outcome in terms of his net pre-tax proceeds and those proceeds compared to the net worth of the business at the time of sale. Section 4 depicts the buyer's outcome, including the sources and uses of funds to accomplish the purchase, borrowing rates and debt repayment terms, loan advance rates on accounts receivable, inventory, and fixed assets, the valuation of the business 4 years hence, and the annual pre-tax rates of return achieved by the providers of equity and subordinated debt as compared with their target rates of return. Valuation estimates that are at or below the value of the company's tangible assets indicates the company's financial forecast especially the sales and profit forecast, does not support a valuation above a book value transaction, which is a value similar to the value of the company's tangible assets at the end of the first forecast year. The first of three primary financial reports is the income statement report, which, like the other reports in this menu section, displays both actual and forecast data. The other income and expense section of the income statement for the forecast years 2 through 4 reflects the introduction of additional financial operating risks as a result of the leveraged buyout transaction. The second primary financial report is the actual and forecast balance sheet report. The forecast section shows the balance sheet of the company as of the acquisition date and at year end for the succeeding 4 years. The final primary financial report is the actual and forecast cash flow report. Next is the Principal Assumptions Relationships report. The LBO valuation model contains 183 assumptions in total. That's 35 income statement and balance sheet assumptions for each of the 5 forecast years, plus 8 assumptions relating to the valuation and rate of return objectives of the buyer. With respect to the primary financial statements, we forecast information at approximately the same level of account detail as an accountant's standard year-end report. Finally, we have 2 financial metric and performance reports. The financial management report is organized into 6 management sections: working capital, assets, liabilities, profitability, debt, and bank borrowings. The report contains 43 different metrics for each of the historical and forecast years. Where appropriate, how the metric is calculated is displayed underneath the metric's name. The financial feasibility report is a subsection of the management report and focuses on debt service metrics that are particularly important to lenders. That completes our review of how to create an LBO valuation analysis and the 8 reports that document the results. To recap, to create an LBO valuation with our software, a user must first create a 5-year financial forecast using our forecast model for either an established, startup, or early-stage business. On the member menu, listed underneath that completed forecast, is an option to create an LBO valuation model. When a user clicks on Create an LBO Valuation Model under a company forecast, he is transferred to the Establish LBO Criteria page, where he enters 2 assumptions that are treated as constants for both the Case 1 and Case 2 LBO analyses. When he saves those 2 assumptions, he creates the LBO model relating to the company forecast, and he is transferred to the Case 1 menu page. There he revises the LBO model's 5 placeholder assumptions with ones that are more relevant to his analysis. Upon saving the revised assumptions, he creates his first draft of an LBO valuation for the company, which is documented with 8 reports. That's all there is to it.